My name is Jake, welcome to the channel. In today's video, I want to talk about a future dividend aristocrat in DLR. That's what we're going to talk about in today's video. I want to do a deep dive into this company. I want to share with all of you some of the things that I look for when I research a dividend stock and just some overall things that maybe you can, maybe you haven't considered before. And I'm going to walk you through my process. And I've done a ton of research for this video. I can't remember the last time that I did so much research for an individual video. It's been, there's a lot of stuff that I want to go over, and probably about a third of what I prepared, I probably won't end up sharing in the video. Otherwise, it's going to be over in an hour, and I don't want the video to be super, super long, but I want to give everybody enough detail, enough information so that really you can do this on your own. And so in today's video, we're going to talk about a future dividend aristocrat, but it's actually not in my cash flow portfolio. My cash flow portfolio is all just, qualified dividends, companies like Coca-Cola, Pepsi. I do have a few covered call ETFs, which are not qualified dividends, but this company that we're talking about, DLR, is in my real estate portfolio. My real estate portfolio here in M1 Finance is really just on autopilot. I dollar cost average every single week. I don't have a lot of holdings in here. I only have 11. I have one ETF in VNQ, and I have individual companies, and half of it is really focused on current income, like, companies that have a higher starting dividend yield, for example, like OHI, WPC, MPW Good, for example. But I also have some more growthy companies in here, like Extra Space Storage, DLR, the company that we're going to talk about today, Prologis, American Tower, and these are some of the the higher growing or the faster growing companies. So this company is a data center REIT. So in today's video, we're going to cover a couple topics. The first, I want to go over what a data center REIT is, kind of help you understand the differences in the different types and sectors of REITs. Second, I want to do a deep dive into DLR. I want to review the dividend metrics. I want to understand how DLR is taxed. I really want to go into detail into the portfolio overview, what kind of buildings and, infrastructure that they have. But also, I want to go into the fundamentals. I want to look at their funds from operation. I want to look at their revenue growth, their margin growth. I'm going to dive into the Morningstar report. I'm going to talk about the risks, the bull case, the bear case for this company, and all of that fun stuff. So really into detail. I'm going to talk about their top tenants, right? A really, really in-depth video when it comes to this company. And then lastly, I want to talk about how DLR compares with the S&P 500, because the S&P 500 really is that benchmark. And so we're going to compare the total returns over the last couple of decades when comparing it to the S&P 500. If you're new to real estate investment trusts, REITs, I'll leave a few links in the description below where you can go and you can do some additional research. So if this is the first video that you're watching when it comes to this, there's going to be a few links in the description where I talk about what is a REIT, what has been the historical performance of REITs compared to like the S&P 500, how are REITs taxed, and understanding, maybe for example, healthcare REITs, a different sector in real estate. If you've been investing in the stock market this year, you've seen a lot of volatility. Now, that volatility is not equal across all sectors of the market. For example, if you're a dividend investor, yeah, sure, you've seen volatility, but nowhere close to the volatility that we've seen in, for example, non-profitable growth stocks. But investing into the stock market always comes with volatility, but that level of volatility is different depending on if you're a dividend investor or a pure growth investor. And it's kind of looked a little like this. Oh my gosh. Oh, I love it. I love it. All right, cool. So let's take a look at a few REIT sectors here. When you're investing into real estate, you can invest into pretty much everything under the sun. You have office REITs, you have industrial REITs, you have retail REITs. This is what I think most people think about when they think about, REITs. You have, hotels, lodging, resorts. You have residential REITs, right? You have these multifamily, massive apartment complexes. You have even timber REITs. You have healthcare REITs, self-storage REITs, infrastructure REITs. This is like your cell towers. You have data center REITs. This is what we're going to talk about in today's video. Data center REITs, they really own and manage facilities that customers use to safely store their data. The customers that they're talking about in this case are usually larger businesses, and that could be like an Oracle, like a Microsoft, an Amazon, for example, large businesses that store their data centers in these facilities. And these buildings are not just like any run-of-the-mill buildings. These are air-cooled buildings. They're not, the temperatures are regulated so that they're not overheating. Fires are a huge thing here when it comes to data centers, making sure that they're safe, secure, all of those things. That's what makes up a data center. And these data centers, as the world becomes more globally connected, these data centers are going to be in higher demand. A couple of resources that I'm going to use. I absolutely love this website. I use their website all the time, and it's a free site. They have a lot of great information. I've shared this on the channel a couple of times. I'm not affiliated with them. I just really, really love their site. I think there's a lot of free value for your do-it-yourself investors. So we're going to do a lot of stuff here in All REITs, and I'll leave a link in the description below because this website is not very well known, well, at least not yet, but they're really, really great at really when it comes to REITs and researching real estate investment trusts. In fact, one thing what I will do is I want to show you this because I thought this was really cool. I was talking to Daniel, the guy who owns or runs All REITs, and they're coming out with a new feature. It's called portfolio management here. And what you can do is you can manually enter in your portfolio, and I will leave a link in the description below because you won't see this page on the website. You actually have to type it in your browser, and I'll leave a link to it. But what you can do is you can create your own portfolio. And one of the coolest things that they do is, one, they'll send you a weekly email giving you an update on your portfolio's performance, your winners, your losers over the last week. So that's really, really cool. In fact, let me show you that here really quick. So this is the email that I got sent. So I sent this up here last week. It shows all of my holdings, my best performing, my worst performance holdings, the change in price by earnings, just a lot of really cool stuff for a free website. I was really, really impressed. But one thing that I thought was really cool is you can see the annual dividends based off of the number of shares that you have. And so when you fill out your portfolio, you'll enter in, your cost basis, the number of shares, all that jazz. But you can see here in my real estate portfolio, this is not including the ETF VNQ. Besides that, I'm going to be generating over $5,500 on an annual basis with a current yield on cost, or a current yield, not yield on cost. The yield on cost here is 5.26, but the current yield, forward yield, is just under 5%, which is really cool. I thought it was interesting. You can see your breakdown of your holdings, the different sectors that you have. And this is what I thought was really, really awesome, is you can see your holdings by how many dividends that you're getting on an annual basis. I thought that was really, really cool. So huge shout out to Daniel. Once again, this site right here, the portfolio section, you won't be able to access it on the website, but there's a link in the description below. Not an affiliate link, but yeah, check it out if you want to. All right, so let's take a look at some data centers here. So really, this is a duopoly. There's really two large data centers that are publicly traded right now. There's a few other small little things and companies. CoreSite was just acquired by American Tower, so they're part of American Tower. So we're not going to talk about them. But what we're going to talk about is primarily DLR and Equinix. Equinix is actually a little bit bigger than DLR, and they're growing a little bit faster. So Equinix is, when it comes to the growth aspect of it, Equinix is a faster growing data center REIT, but they don't have the dividend history like DLR, and they don't have as high of a starting dividend yield. So your yield on cost over the long term may potentially be better with Equinix, but if you're looking here, if you have a shorter time horizon, maybe 5 to 10 years, DLR is really, really attractive in my opinion. So let's take a look at a few different things here. So let's take a look at the market cap. Well, here, first, actually, All right, so this first, you can see the dividend yield. I love this website. DLR has a much higher dividend yield, and you're getting it's a much more affordable. So in REITs, you're not going off the PE ratio. So that's a big mistake that a lot of new investors make when they're evaluating and valuing real estate investment trusts, is you don't go off to the price to earnings. There is still a price to earning for DLR. So if you go to Google or Amazon, yahoo.com, and you type in DLR and you're going to see the PE ratio, disregard that. It's irrelevant. What you want to look at is the price to earnings based off of the funds from operations. And if you even want a better metric, you want to look at the AFFO, the adjusted funds from operations. And here DLR is trading at is a better valuation, a better quote unquote PE, right, than Equinix. So that's something that I wanted to highlight that I thought was pretty interesting. But yeah, Equinix is a larger company by market cap. And let's take a look here. Let's look at the earnings growth. Earnings growth is important. DLR is a higher earnings growth per share. DLR is a little bit bigger. Let's look at the forward dividend growth. Equinix is growing its dividend faster, but once again, Equinix has not been paying a dividend as long as DLR. So there's not as long of a history when it comes to back testing that. Looking at the dividend growth, dividend growth for Equinix, once again, much higher. However, the starting dividend yield is much higher with DLR. So this is what it comes back to, what I always say on my channel, the time horizon really dictates how you should be investing. If you have 20, 30 plus years before you want to live off the dividend, this is your winner. Equinix is your obvious winner. You look at this, assuming that this stays constant, and I don't have a crystal ball, but if you have a shorter time horizon, DLR is in a much better position, in my opinion, when it comes to that. Now, I want to take a look at the Morningstar report here for DLR. There's a couple of things that I want to highlight here. They do have, according to Morningstar, a narrow economic moat. The big thing with DLR, the reason why they have an economic moat, and we'll get to that really in just a second, is the switching costs. When a company, a software company, a cloud company goes onto their network here and works with them, it's very difficult to switch, or there's a high switching cost. So a couple of things that I want to walk through this really quick is what the bulls say, what the bears say, because I don't want to paint a picture that, like, hey, everything is perfect and rosy, because that's not the case with any company. There's always a bear and a bull case. The bull case is that digital realty is shifting towards a connection and a co-location model. So co-location is a little bit different than what they're doing. I'm not going to sound smarter than I really am, but essentially what it is as this industry continues to innovate, this is a big deal, and where the innovation is going. And Equinix is a little bit further ahead when it comes to the innovation of the next gen of data centers. So that's how I understand it, is when you think about 3G, 4G, 5G, all that stuff, Equinix is a little bit further ahead of them when it comes to the next generation of innovation when it comes to data centers. So that's the way that I kind of summarize it for me. Also, let's see here, bull cases, digital realty's global offering and high exposure to cloud providers gives it an advantage over its competitors that operate in more narrow geographies or can only offer retail co-location space. Internet of Things, artificial intelligence. So the big thing about DLR is they're very focused on cloud. They're focused on cloud providers like IBM, Amazon, LinkedIn, like really just cloud providers. Whereas Equinix is more diversified across more industries and not just focused on cloud. Okay, so what are the bears saying? So for example, digital realty is too dependent on cloud service providers, essentially what I just said there, and leaving it at the mercy of those companies. So they do have a higher weighting towards their top tenants. And so if there's churn with their tenants, that can provide a bit of risk. So obviously that's what some of the bears are saying. All right, the next thing that I wanted to talk about was their revenue growth and the revenue growth by percentage. This is really important when you're investing into a dividend growth company. And I said at the beginning of this video that this is a future dividend aristocrat. This is what I'm looking for. Do they have pricing power? Are they able to grow their revenue year over year. That's incredibly important because if they're not able to grow their revenue and thereby grow their net income, right, their funds from operation, this becomes challenging to then ultimately grow their dividend per share. But as you can see here, this is a growing, stable business. Okay, and one of the things that's important to me is when I'm looking at these things, when I'm looking at revenue growth, I'm looking at the net income growth of a business, the funds from operation. These are the kind of things that I'm looking for. I not only like to look at historical performance, but I also like to look at forecasts based off of the analysts that are following this company. And for example, you can see that they're projected to have continued annual dividend revenue growth here through 2024. So this is pretty cool to see that they're going to see revenue growth rates of around 7 to 10% over the next couple of years, which is great because if you're a dividend investor, you can anticipate a dividend raise or a dividend increase every single year. And that's why I'm saying with, and we'll get to the dividend metrics in a second, this company is a future dividend aristocrat. If they're able to maintain this trajectory and this path to growth and profitable, and remain profitable and be able to continue to grow their earnings per share, they're going to be able to reward you as a shareholder, if you're a shareholder, with a growing dividend. All right, now I want to take a look at their 10K here from their Q1 here in 2022, and I want to take a look at a few risks that they outline here in this document that they foresee as risks. Now, a few things that I want to highlight, I'm not going to read all of this, but some of the things that I found were interesting was their business depends upon the demand for data centers. If we believe that there's going to be less demand for data centers, then obviously DLR, digital realty, is going to be hit. But I truly believe that with this duopoly that we're seeing here with Equinix and DLR, and also with CoreSite, part of AMT, but we're not going to talk about that, there's going to be continued demand for data centers. As the world becomes more connected, there's going to be more need for data centers. And the thing that's interesting is this is a global company. It's not just here in the US. And as you see these developing markets start to come up, you're going to see more demand in those growth markets. And that's where you're going to see DLR expand and grow its revenue, grow its margins because of these emerging markets here. Now I'm talking more, in different parts of Asia, South America, and different parts of Europe. That's what I'm talking about. But yeah, there's definitely a handful of risks here. One of the things that I wanted to make sure that I outlined here, let's see if I can find it. This is the one thing that I thought was really interesting. And this is interesting because of where we're at in the market today with the Fed raising interest rates. Our growth depends on external sources of capital, which are outside of our control. So if the Federal Reserve raises interest rates, it becomes more costly for them to acquire new locations, new buildings, because the cost of capital is going up. So I thought that this was really interesting. I think over the long term, when you think about real estate investment trusts, you can't have a short time horizon. You really have to think in decades, because when you buy a house, right, unless you're a flipper, you're trying to buy a fixer upper and flip it, an investment in real estate is a long-term investment. And so when you think about the CAGR, the compounding annual growth rate, you really have to look out and look at years and decades to really be able to visualize the actual CAGR of the investment. All right, one last thing here that I want to share on the financials. If you look at their first quarter here in Q1, one thing that I really like to look at, and I don't want to go through this entire document, we already said that they're growing their top of line, their revenue growth is growing. What I'm looking at as a dividend investor is this right here, their funds from operations per share. This is what I look at when I'm looking at a company. Is it continuing to grow? When you're valuing a REIT, this is different than Coca-Cola or Pepsi. With a REIT, you want to look at the funds from operation, ideally the adjusted funds from operation. But this is what I'm looking at. They're growing their funds from operations per quarter. And so this is really, really great to see. All right, so let's go back to all REITs here really quick. So when you look at this is what I find so interesting is all REITs will actually grade a real estate investment trust based off a few different things. Their debt, their years since IPO, their funds from operation growth, their dividend growth, and their payout ratio. All very, very important things. So what I would encourage you to do is take a look at this and compare it with another company. Let's do one really, really quick because I'm interested in it. Let's take a look at NRZ. NRZ is really, really popular here on YouTube. NRZ is not nearly as favorable as DLR when it comes to some of these other metrics, for example. So I don't know, just something interesting you could take a look at. Let's look at another one that I really like. Let's look at MPW. MPW is good. Just the debt part is not so great right now. Let's take a look at realty income. Realty income also really good. Okay, let's go back to DLR. All right, so once again, funds from operation, the valuation here is fairly decent. I could definitely see this retracting back to about 15. So we'll see. I don't know. DLR is pretty pricey right now. But the dividend history here is pretty good, actually. The one thing that's kind of questionable, and this comes back to the time horizon, is the dividend growth. The dividend growth is not quite as high as Equinix or other growth REITs out there. But once again, the key thing here is it has almost a 4% dividend yield. Equinix has half of this dividend. Okay, what other things do we want to look at? There's so many cool things. We're going to go to their website and I'm going to show you the country diversification. But isn't this incredible? This is already embedded on the website here. This is why I love this website so much. All right, now let's take a look at the dividend metrics. And I love using Seeking Alpha. I'm a huge fan of Seeking Alpha. Let's take a look and see the dividend metrics here with Digital Realty Trust. Just under, just right around a 4% starting dividend yield, a pretty high payout ratio. I'm not concerned about this. 5-year CAGR on the dividend is just over 5.5%, and dividend growth over the last 17 years. So really, really impressive. Let's take a look at the yield on cost. So this is the first thing. The 4-year dividend average is 3.27. So if you were to buy today, you're at these prices, you're getting a higher starting yield than the 4-year average. And that's, for me, I kind of like using that as a benchmark for value. And I think it's more in value territory today, at least, comparing to the last 2 years here. But one thing that I want to make sure that I mention is if DLR becomes a dividend aristocrat, you can just bet your britches that DLR will demand a much higher price tag because it has that status of dividend aristocrat. Right now, you have quite a few years, a couple of years before it reaches that status. So you're not going to be paying that quote unquote premium for the dividend aristocrat status. So if you're accumulating shares now for the next couple of years before it becomes a dividend aristocrat, I think you're going to get a much better valuation than once it gets, that dividend aristocrat status. That's just something that's kind of on my mind. It's similar to the Warren Buffett effect. All the companies owned by Warren Buffett command a higher price tag or a higher valuation because Warren Buffett owns it, right? That's just kind of how it is. So that's one of the things that I'm thinking about when I'm looking at DLR. The dividend growth, as I mentioned, has not been super crazy high. This a lot has to do with, the sector itself. It has to do with the maturity of the company. It also has to do with how their leases are structured. If they have rent escalations already baked into their leases, which we'll get to in a second, actually, this is kind of to be expected of a company like this, that you're not going to have like a 12 or a 15% dividend CAGR. So another thing really great to see is the dividend history. It has amazing dividend history. Once again, this is going to be a dividend aristocrat if it continues down this path. So really exciting stuff about that. Dividend estimates, I like looking at this as well. We touched on this briefly in the Morningstar report here, but analysts are assuming, or the consensus rate is here by 2024, you're going to see a $5.33 annual dividend payout per share. And today, 486, today we're at 488 is where we're at today. So a decent leg up from where we're at today. But once again, it's not a 12 or 15% CAGR. It's a respectable 5-6%. But once again, when you zoom out and when you look at the dividend growth of DLR, since its inception here in 2005, since the company went public, if you invested since the company went public, you've enjoyed a 10% CAGR on the dividend since 2005. So that's one of the things, like when you're investing into real estate or real estate investment trust, you can't look at this as a short-term investment. If you look out in decades, that's where you're really going to see these larger CAGRs, these double-digit CAGRs, is when you're investing for the long term. All right, let's touch briefly on how the dividend is taxed. This is a real estate investment trust, so you're not going to get the most favorable tax treatment. This would be best if you were to hold this in a Roth IRA, for example, or tax sheltered account, so you're not paying taxes on the dividend. You're not getting favorable tax treatment with this company. When I looked at my tax records here for 2021 from M1 Finance, I think it was like 100% just ordinary. The dividend was just ordinary dividend. I don't think there was any return of capital, but yeah, here's the formal documentation, the formal press release from the company. So if you want to take a screenshot or pause the video, this is how they formally disclosed how the dividend was taxed here in 2021. All right, now let's take a look at Digital Realty and their portfolio. So they have over 290 data centers across the globe. They have it broken up into different types of data centers. This is the innovation. I was talking about this a little bit earlier. You got the interconnection, the co-location, and all of that stuff. So this has to do, the lingo here is very specific to the industry, and I'm not an industry expert, so I'm not going to pretend like I am. I just want to make sure that I kind of highlight some of the main things that are important if you're a regular investor. This is the 7th largest publicly traded REIT in the US. And that's pretty big, actually. That's pretty good. What are some other things that I wanted to share here with you? One of the things that's important, I mentioned this earlier as one of the potential risks that they outlined in their quarterly report was the demand for data centers. I honestly believe that there's only going to be continued demand in this space as the world becomes more connected, not only in consumers, but as governments become more connected, as enterprise businesses become more connected. There's going to be more and more demand for this technology, and not just in developed markets, but in emerging markets as well. There are 291 data centers across 50 metros, 58% in the United States, 5 in Latin America, 10 in APAC, and 27 in EMEA. What I think is going to be interesting is here in APAC, as they continue to grow in those growth markets, that's where I see more growth potential going forward. You look at this, I don't even believe that they're in India, right? India is such a massive market. Like I don't know why they're not, I don't know why they're not over there. But you look at their growth markets, you look at EMEA, there's still room to grow. South Africa, or Africa in general, there's room to grow. Brazil is a massive market. I think when I think about emerging markets, I think of a couple that come to mind. I think about India. I think about Brazil, South America. I think those are the areas where a lot of businesses are going to see scale and growth here in the next decade. So just a few things that are on my mind when I'm thinking about this. Let's take a look. What are some other things? There was a few other slides that I wanted to show you all here. Let's take a look at this. So this is, okay, perfect. This is exactly what I was looking for. So as I mentioned, they have rent escalations or rent increases on an annual basis already baked into their leases. They have on average a 2 to 4% annual rate increase. But what's interesting is a large percentage of their leases are ending here this year and next year. And what I think might happen is as they renegotiate these lease terms, they're going to be able to bake in the increase of inflation. And so I think they're going to be able to increase their the rent increases on an annual basis to reflect that of inflation. So I actually think that this is a positive, because when I first looked at this, I was like, oh no, that's pretty risky. Here this year and next year, almost 40% of their rent is up for renewal, but it's actually a good thing because that means that they can raise their rents and increase it. So just something to think about. This is the last slide that I wanted to show here, was the dividend yield and the dividend growth here, as well as the adjusted funds from operation payout ratio. So pretty interesting stuff. All right, another thing here that I wanted to talk about, as I mentioned earlier, this is a data center REIT focused primarily on cloud. And so their largest tenants here, their 20 largest tenants are Fortune 500 companies. That's the first one here, but IBM being the second, Oracle, Facebook, LinkedIn, Rackspace, JP Morgan, Comcast, Verizon, AT&T. Just there's a huge focus on cloud companies. And so I think, that was one of their risks that they outlined in their quarterly report. But I see it as an advantage. I think these cloud companies are only going to continue to grow, and the need and the demand is only going to grow. One thing that I like doing when I'm looking at real estate investment trusts, I love looking on Google Maps and seeing the actual physical building. So when I go over here to Google Maps, I can take a look and I can actually see the building here on Google Maps, though it's kind of on a hill here. But this is the data center here from DLR, from Digital Realty in Austin, Texas. This is like 20 minutes away from my house. And so it's pretty cool to see, the actual building here on Google Maps. And, a lot of times when you're investing into companies, you're like, okay, I trust that I'm investing into something, right? Maybe not. Like, this is a tangible physical building that you can drive by and you can look at. And for me as an investor, I love this because I like things that I can comprehend. This is a building. There's value to this building. It generates income. And I love investing into things that generate income. All right, now to wrap it up here, I want to take a look and I want to see how DLR has compared to the S&P 500. The S&P 500 here, now what we're going to look at, this is on seekingalpha.com. What we're going to do is we're going to take a look at the total return. The total return is important because this is the with the dividend reinvested, okay? If you just look at the price action, then yeah, it's not going to give you an accurate picture. So you have to look at the total return. Here the last year, DLR has traded pretty neck and neck with the S&P 500. Over the last 5 years, DLR has trailed the S&P 500, okay? And this is once again with the total return. Over the last 10 years, DLR has actually trailed the S&P 500. Now, I was thinking about this. Well, why would you not just invest in the S&P 500? Well, one of the reasons is when you invest into a company like DLR, you invest into this company for the cash flow. You're not investing into this company so that you can buy it at $100 a share and sell it at $200 a share and being able to time the market perfectly, buy it at 100, sell it at 200. The timing piece of it is kind of wonky, but the reason why you invest into a company like DLR is for the consistent cash flow and for the consistent dividend growth. That is the key difference. So there's going to be a lot of people out there who are like, well, Jake, that's dumb. Why not just invest into the S&P 500, dummy? Well, yeah, I mean, I get it. I understand, right? It's more tax efficient, depending on which account you hold it in, but it's a different style of investing, right? If you're an income investor, you want income and you want that income on a regular basis, and you're not looking to time the market. And so in my opinion, as an income dividend investor, I really like investing into companies like DLR, though they do trail the S&P 500. That's part of the reason why this is not my largest holding. I don't have all of my money in DLR. DLR serves a very specific purpose in my portfolio, and it serves the purpose of continued dividend growth, but current income. All right, so I want to do one more thing, and I want to compare against VNQ. So VNQ is the the Vanguard real estate ETF here. And this feature right here where you're comparing additional ETFs or stocks, you can't do that with the free version. In most cases, you can get away with the free version here on Seeking Alpha. I do personally like the premium version. I've been using it for a while now. I really like it. You can read all the articles without a limit. That's pretty cool. I've actually been in contact with Seeking Alpha, their affiliate team. Their marketing team reached out to me and they said that they enjoyed my content, and who doesn't, that's pretty cool. I thought that was awesome. If you do want to sign up to Seeking Alpha Premium, there's a 50% off link in the description below. So if you want to check that out, go for it. If not, hey, that's cool. So, all right, let's take a look at VNQ here. So VNQ, when comparing the total return of VNQ versus DLR, you can see that DLR has actually outperformed VNQ. So that's kind of cool to see. But yeah, all in all, what's important here is I like comparing apples to apples. VNQ is a REIT ETF. I like comparing it to DLR, which is a REIT. And you can see here that DLR has actually outperformed VNQ, which is pretty cool to see. It's just a different way of viewing this and comparing the historical price action and performance of the different investments here. All in all, after doing all the research on this company, I personally am a big fan of this company because it really fits my time horizon. As I mentioned, it has a very high starting dividend yield for a growth company that invests in the future, right? Data centers, I don't think are going anywhere anytime soon. It's a very sound company with, they're growing their top of line, they're growing their funds from operation. They're an overall well-established business globally for growth. And I think this is a great fit for my portfolio. That's why I invest in it. And those are some of the things that are on my mind when I'm thinking about a company like DLR. So I hope that this was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.